You open the app. Before you can even think, the number hits you. Minus 38%. Not the kind of drop that crashes in a day and rebounds. Not a sharp fall that ends quickly. It goes down slowly, steadily, and cold. Day by day, bit by bit. You don't notice it at first. Just a few percent, then a few more, until one morning you open it again and realize it has gone too far.
Subscribe for more story about money, power, and the system.
Every day you still open the app, still hoping that today it stops. A green candle, a reversal signal, something. But it doesn't stop. It keeps sliding. Your account has lost a third of its value. 20,000, 30,000, maybe more depending on where you are. But the number isn't as important as the feeling. The feeling of watching your money being eroded right in front of your eyes with no way to intervene. No warning, no email, no one calls to say, hey, something's about to happen. No one prepares you for this moment. Just you. And a button. Sell. You look at the chart. Zoom in, zoom out, change the time frame, trying to find some kind of logic. You start looking for reasons. News, interest rates, inflation, war, the Fed, policies, economic data. Everything starts to make sense. But there's one detail you can't ignore. All of those reasons only become clear after everything has already happened. None of them show up beforehand to help you avoid it. And now you have to decide. Hold and accept it may go down even further. Or sell and turn the entire loss into reality. No longer a temporary number. No longer an unrealized loss. But real money gone. This is when the market stops being a concept. It becomes something very personal, very direct, and very real. But there's something even more real. This moment isn't about the market. It's about your position in that market. Because while you're sitting there, hesitating, weighing, almost frozen, there are others doing nothing at all. Not because they don't know what's happening, but because they don't need to react. They don't panic. They don't rush. They don't open the app every 10 minutes to check again. They're not looking at the same screen as you. They're not in the same perspective. They were already in a different position before you even realized there was a problem. They don't react because they're not the ones being put in a position that requires a reaction. And that's when something starts to crack, a feeling that's hard to name. You start to wonder, am I slow? Do I lack discipline? Did I choose wrong? But if you pause for a moment and look closer, the answer may not be what you think. You're not slow. You don't lack discipline. And very likely, you didn't lose because you picked the wrong stock. You're just standing in a position where reacting is the only option you have. And if you've ever believed that investing is about learning to choose right, choose better, become smarter over time, this is where the story starts to turn in a different direction. This video, at first glance, looks like a video about levels of investing. Where you start, how you move up, how you optimize your strategy, how you build wealth over time. Sounds familiar, sounds reasonable, sounds like everything you've ever been taught. But that's just the surface layer. This isn't about becoming a better investor, not about picking better stocks, not about optimizing your portfolio. This is about a much more uncomfortable question. Why do most people never leave the level they started at? It's not that they don't try. It's not that they don't learn. It's that they can't leave. And if you watch long enough, you'll start to see something. Investing is not just a skill. It's a filter. A very quiet system, but extremely precise at stratifying. Who gets access first? Who only gets to participate later? Who stays close to the flow of money? And who has to stand where it's absorbed? And most importantly, who stays long enough to keep the entire machine running. If you still think this is all just a matter of knowledge, that if you just learn more, read more, you'll level up, then the next part might feel a bit uncomfortable. Not because it's complicated, but because it's too simple, yet no one says it directly. Before understanding how this system works, you have to go back and face what you believe is true. You've been taught to diversify. Don't put all your eggs in one basket. Split your portfolio. Reduce risk. You've been taught to invest long-term. Ignore short-term volatility. Time will fix everything. You've been taught about DCA. Put money in every month. Don't try to time the market. Just stay in the market long enough. And honestly, those things are not wrong. Most of the time, they work. You put money in, the market grows, your portfolio gets bigger, numbers go up, profits accumulate. A very simple flow. You to the market, to growth, to profit. Clear, easy to understand, logical. And in that story, you are the one in control. The one who learns, the one who improves, the one who gradually becomes better. A game where, if you are disciplined enough, you will win. At least, that's the story you were told. But there's a small detail that very few people stop to question. If this is truly a game of skill, why are the outcomes so different? Why are there people who almost never get pushed into situations where they have to react, while others are constantly forced into decisions where each one feels like survival? And more importantly, the money you're putting into the market every month, where is it actually going? How is it being used? And ultimately, who is it serving? If you want to answer those questions, you'll have to do something uncomfortable. You have to ignore the safe version of the story, the version that sounds good, the version everyone agrees with, and go a bit deeper into how this machine actually works. If you're ready for that part, stay. You look at the same market as everyone else, the same charts, the same news, the same data that anyone can access. Nothing is hidden, at least on the surface. But then you start to notice something. The outcomes are not the same. Some people see volatility as opportunity. Others see that same volatility as risk. Some are barely affected. Their portfolios keep operating as if nothing happened, while you are pulled into a continuous loop of reactions. Open the app, check, speculate, decide, repeat. And that's the first paradox. Same market, but not the same game. You've been taught that the market is efficient. Prices reflect all information. No one has a long-term advantage. Everyone starts from the same point. Sounds logical, sounds fair. But if that were truly the case, why does large capital always seem to move first? Why are there movements you only understand after they're already complete? Why are you always on the receiving end of information instead of the side that creates movement? Maybe the answer isn't information. It's capital flow. What you call price is actually just the trace left behind after capital has moved. Information doesn't determine price. Capital flow determines price. And capital flow is not in everyone's hands. At your level, you provide liquidity. You buy, you sell, you create small movements, but consistently. You help the market live. But at the level above, they don't need liquidity. They control it. They don't ask, where is price going? They ask, where will capital flow? They decide when money goes in, when money is pulled out, when an asset is repriced. You react to volatility. They create the conditions for volatility to happen. And when everything is labeled as risk, you were taught how to manage it. Diversify, hold long term, don't panic. But there's one thing no one clearly says. Risk doesn't disappear. It isn't solved, it's transferred from those who can absorb it to those who are forced to bear it. From large balance sheets down to small individual accounts. And when you understand that, a strange feeling appears. It's not that you're bad. It's not that you lack intelligence. It's not that you react slowly. You're just standing at a different level within the same system. A level where your main role is not to control capital flow, but to absorb its fluctuations. And when that perspective forms, the question starts to change. No longer, how do I invest better, but how does this machine actually work? If you break it down, you'll see 3 layers. The first layer is capital flow. You think you're an investor, but in reality, you are part of the liquidity supply. Every month, you put money in, consistently, predictably, without conditions. That flow doesn't just help you accumulate, it gives the market depth. Allows large transactions to happen without breaking structure. Above you, there are other flows: pension funds, insurance, massive pools of capital, and more importantly, very patient. They don't need to react daily. They aren't forced to sell when markets drop. They position based on cycles, not emotions. And above all is the system-wide liquidity layer, not from individual investors, but from the financial structure itself. When needed, it's injected. When needed, it's withdrawn. Not always visible, not always announced, but always present in how the market moves. Money flows in, money flows through. And in between, there are those who don't just invest, but shape that flow. Intermediaries, fund managers. They don't need to be perfectly right. They just need to be positioned correctly within the flow. The second layer is power. You pick stocks, you pick ETFs, you pick timing. You feel like you're in control. But you don't control large capital allocation. The real decisions are made elsewhere. Asset allocators, institutions. They don't trade individual tickers. They allocate billions across asset classes. They don't ask which is better. They ask how much capital should go here. One decision from them can create an entire trend.
Subscribe for more story about money, power, and the system.
What you call the market going up may simply be the result of a large allocation flow. You see the outcome. They create the conditions. And most of the time, you don't see the full picture. You only see the part you're allowed to see. The final layer is consequence. When markets go up, profits are not distributed equally. Upper layers can use leverage. They multiply gains at scales you can barely imagine. 1% for them is millions. For you, it's a number that makes you feel like you're making progress. But when markets crash, everything becomes much clearer. Volatility doesn't disappear. It flows downward. You absorb it through your portfolio, through the decisions you're forced to make, under pressure. And on a larger scale, some losses don't stop at the market. They are restructured, absorbed, transferred elsewhere. Not everyone bears risk equally. This system is not designed to distribute risk fairly. It is designed to ensure that risk always has somewhere to go. And if you look closely enough, that place is rarely at the top. This is when your perspective begins to shift. Not how you invest, but how you see yourself within this system. You started, like many others, with a very simple belief. If you're right, you win. Pick the right assets, hold long enough, be disciplined enough. Sounds reasonable until you go through your first drawdown. 30%, 40%, maybe half. Not because you didn't research, not because you didn't understand, but because you're in an environment where volatility is the default condition. And that's when you learn the first lesson. Volatility is real. Not a concept, not a theory. Something that can take away a large portion of your assets, silently. You begin to change. You become more disciplined, less emotional, more cautious. You optimize your portfolio. You reallocate. You read more, understand more. You do everything more correctly. But there's a feeling that doesn't go away. You do things right, but the outcome still isn't fully yours. You don't panic anymore, but you're not truly in control either. You start to wonder, am I still missing something? Or was this game never designed for you to control the outcome? This is where many people stop. They think they need to learn more, improve more, optimize more. But if you go a bit further, you'll see another possibility. You didn't fail. You're playing your role correctly, providing liquidity, absorbing volatility, staying long enough. Not because you're forced, but because everything is designed for you to believe that's the only way. And when you begin to see that, another layer of the system opens. The levels you once thought were progress are actually doors. And each door doesn't open with knowledge. It opens with conditions. A minimum capital threshold, a close enough relationship, a timely introduction. You can read everything, understand everything, but if you don't meet the conditions, you don't get in. No one tells you you're excluded. You're just not invited. At your level, everything appears public. But as you go higher, the best opportunities disappear from sight. No ticker, no chart, no promotion. They are distributed. Private deals, internal allocations, network-based opportunities. You don't find them. You can only receive them if you're already inside the right network. And that's when you understand. This is not a game of discovery. This is a game of distribution. Not who moves faster wins, but who gets access first. Not who is more skilled goes further, but who stands closer to the flow. And that's why most people stop. Not because they lack discipline, not because they lack knowledge, but because they hit a ceiling no one talks about, but always exists. You can optimize forever, but you're still at the same level, while above is an entirely different system. And when you look far enough, an uncomfortable truth emerges. This system is not designed for you. It's not optimized for fairness. It's optimized for liquidity. It's not designed for everyone to rise. It's designed to preserve capital, where capital already exists. It's not optimized for your personal experience. It's optimized for the stability of the entire structure. And within that structure, you are not a flaw. You are a necessary part. Retail is not a bug. Retail is a feature. You keep capital flowing steadily. You absorb volatility. You keep the machine running. And no one needs you to lose immediately. They just need you to stay. Stay long enough for everything else to function smoothly. And when you look back at yourself, everything becomes very real. You've been DCAing for years. Your portfolio has grown, but the feeling hasn't changed much. You don't feel richer because while you accumulate, other forces are eating into it. Inflation, uneven distribution of growth, late access to opportunities. You always feel like you arrived late, and fear begins to form. Fear that you don't fully understand the game. Fear of being left behind. Fear that something hasn't been said. You learn more. But the problem may not be knowledge. It may be the story you believe. And if that story is wrong, everything you do right still leads you to the same place. And when you return to the original moment, the negative number, the sell button, the feeling of losing control, you begin to see it differently. You don't need to panic for the system to run. You don't need to lose for others to win. You just need to continue. Continue putting money in. Continue reacting. Continue believing you're moving forward. And while you do that, the machine keeps running. It doesn't need you to understand. It doesn't need you to agree. It just needs you to stay in position. The system doesn't need you to fail. It only needs you to stay where you are. If you want to keep peeling back the layers that most people never see, stay for the next video.
Subscribe for more story about money, power, and the system.